Good afternoon and welcome to the Wealth of Advice Market Update on the 6th of June 2020. It's been a positive week overall for investment markets. The FTSE 100 and the FTSE All Shares, you can see there, have had a great week, outperforming both the US market and the MSCI World Index. We were really pleased that this happened following the presentations we'd done a few weeks ago, where we were saying there were certain client portfolios which were more UK focused were lagging behind the other ones because the UK markets hadn't done so well. Fears over Brexit and how the government had handled the pandemic was weighing on those stock markets. So to see them come back so nicely this week, obviously on the back of the lockdown measures coming to an end, or easing certainly from last week, and businesses getting back and running, shows you that the market's like that, and any sign of positivity is reflected in the market growth. That said, over the last 12 months, FTSE All Share and the FTSE 100 have both lagged behind the other two indices we highlighted there, the American market, the S&P 500, and the MSCI World Index, which is a collection of the biggest companies in the world put together as an index. Both of those two indexes are positive by double-digit returns over the last 12 months, which is quite frightening, really, when you think how much the markets fell February, March into April before recovering. And as you can see from those lines there, the red and blue line at the bottom, the UK markets are still lagging way behind over the longer period of time. The previous slide was over the last week. This one's over the last month. The FTSE All Share up 11.5%. The FTSE 100 almost identical, 11.26%. And the US market and the world market not that far behind. The US market finished like a train on Friday night with the announcement that their unemployment figures were better than expected. So I would guess the S&P 500 figures probably is closer to the FTSE All Share now. But to be back on a par with them, at least, if not slightly ahead, is great, considering that the slides we showed last week and the week before where we were so far behind. The main stories in the UK news this week: Brexit negotiations carried on. Lots of negative news stories appearing in the press. I think a lot of them are coming from Europe. The Europeans would like to put fear into the UK people, to put pressure on us to sign up for a deal that they really want as much as we do. So you're seeing a lot of stories saying a no deal may be happening. I don't buy it. I think we're going to see lots of to and fro over the next few months, and Brexit may become a news story as featured as what the coronavirus has in the last few weeks as we get closer to this December deadline. The story which really caught my attention, we've been speaking so much about vaccines over the last few months, how getting a vaccine will be so crucial to the future performance of all clients' portfolios. The Oxford vaccine, which has been touted as perhaps one of the best in the world, one of the most advanced ones, they said that they're now going to start testing people in Brazil because the infection rate is declining in the UK. So that shows you that the lockdown measures which we imposed in March, which were very draconian for a long period of time, have actually worked, because the amount of new infections is reducing, the strength of the virus apparently is reducing. So the people who are creating the vaccines, this is a negative for them because it's harder to test folks in the UK. So they've gone over to Brazil, where their infection rates are still massively high. I think their death rate has gone above that of Italy now. So they are really sort of in a bad position. Now, from the people developing vaccines, that's the perfect place to go and test it. So again, we're hopeful that a vaccine is going to be found sooner rather than later. And on one of the slides, we'll come to the T. Rowe Price fund managers. They suggested that as well. We saw this week the FTSE 100 change its components. The top 100 companies in the country are selected effectively by a panel. Certain criteria has to be met, and when a company's share price falls continuously over a period of time, like what is seen with those four companies there, Centrica, EasyJet, Meggitt and Carnival, as you can see from a couple of those, quite obvious, Carnival and EasyJet, why they would suffer during the pandemic. I mean, nobody's booking EasyJet flights, or they certainly haven't been. Nobody's been flying with them. So they've been replaced with GVC Holdings, who are a gambling company. Obviously, horse racing started again in this country this week. IDB started showing it on the TV from yesterday. So the betting companies will be expecting that their turnover is going to increase. HomeServe, Kingfisher, Again, they're all going to, and the vast are all going to be benefiting from the lockdown measures starting to ease and people being able to go to shops and buy goods again. So hopefully the markets continue to improve on the back of more and more companies opening up and starting to trade again. World news this week was dominated by the main stories emanating from the US. Unemployment data in the US unexpectedly fell to 13.3%. Economists had feared it was going to be as high as 20%. However, 2.5 million jobs were added during the month of May. This really took economists by surprise and markets by surprise. The US market finished up just over 3% last night, so 3% rise in one day meant the markets last week ended on a very positive note. It's very easy in the US to lay people off and get rid of them, a lot easier than it is in other parts of the world and in Europe, especially where in Italy and France, for instance, it's very, very old-fashioned how employment contracts run. So in the US, it is very easy to get rid of people, as you can see there. It's also very easy to recruit people. So 2.5 million people were rehired during that month. A lot of the states in the US, individual states, are keen to get people working again, keen to get the economy moving. So if they added 2.5 million jobs during the month of May when all the markets and all the economies, parts of the economy weren't open, then hopefully that bodes well for what will happen during the month of June and July and beyond. The other main story in the US that dominated world news, protesting continued across the US, but also now is happening across many big cities around the world following the shocking murder of George Floyd. Donald Trump is really worried about this. He had a big meeting in the White House where he called together all of his main strategists and advisors because they're worried that the Democrats are now ahead of them in the polls and the Democrats may go on to win this election. That in itself is something that our fund managers who we use will need to assess and find out whether that's a risk to portfolios or whether it's a positive thing. In Europe, the European Central Bank, the ECB, pledged to put 600 billion euros into an expanded debt buying program. What does that mean in reality? Well, it allows them to offer loans and finances to companies who may be in a perilous position. So ultimately, it means that companies won't go bust and they will continue to trade through this crisis. Markets like that, if the markets believe companies are going to go bust, then obviously markets will fall, which is what you saw during the month of February. There was a big fear that with a lockdown coming, a lot of companies would have went bust. We saw in the UK and in the US billions and trillions of pounds and dollars put into the system. The ECB's already put money in there. The Japanese have done huge rounds of this. So the ECB were wanting to put more money in. There was a bit of discussion between the various countries on how best to do that, but the markets like the fact that it's happened. And you've seen, I think on previous weeks we added slides which showed the German market, stock market, had done very well on the back of these things happening. We spoke with T. Rowe Price on Tuesday. Julian Cook, who is in their fund management team, he's based in London. We asked him various questions. We had him on a Zoom call for over an hour. A very interesting guy who seems to know everything about virtually every US company that we ask questions about. The T. Rowe Price healthcare team is actually headed up by an ex-doctor, and they also employ an ex-transplant professor from Johns Hopkins University. The healthcare team is there for their analysts to call upon to get information and data about which companies are best served in the current crisis and who would make a good investment opportunity. They believe that having such a strong healthcare team behind them will help them weed out the bad stocks, sell the bad stocks, and invest in things that are going to grow more in the future. They said that they're very, very confident that a vaccine is going to be found in not too long of a time from now, because there's so many countries around the world, there's so many studies happening, that the likelihood of a vaccine coming is extremely high, certainly much quicker than when you've seen other viruses and such like happen in the past. It's been so major that so many countries have got to sort of get at it. So T. Rowe Price was very confident on that. Donald Trump back in February was kind of mocked for saying that this virus would disappear in the summer because most flus worse in the winter, and in the summer things always ease off. Well, T. Rowe Price said you shouldn't really laugh at that, because it may be that any virus of this nature, which affects respiratory systems and such like, will improve as the summer months come. So they are looking towards the southern hemisphere as they move into their winter months to see if the virus is going to return more fiercely down there. And if that does happen, then they can plan ahead as to what may happen in the rest of the world as we move into winter towards the end of this year. So you definitely got to feel there that they've got a real focus and attention on what's going on in the healthcare sector, and how that can then pass on vital information to all of the other funds and other sectors that they deal with. They explained that they were quite surprised as to how resilient the US market has been and how quickly it has recovered. We've said on several occasions that the main large, well, they're not large, they're absolutely mega stocks, your Facebook, Apple, Amazon, Alphabet, Netflix, Google, the FANG stocks as they get called, they've really drove stock markets higher in the last few months. These companies have gone through the crisis where the balance sheet has improved, their stock market price has improved, and this is all borne out from them having a good level of free cash flowing into those companies. So T. Rowe Price said at the end of February how they changed their portfolios was to get rid of the bad stocks whose free cash flow was not going to continue during the crisis. So the airline companies, the holiday companies, shops, restaurants that had to close during the lockdown, they would have been the first stocks that they sold. But as I say, those FANG stocks we mentioned, everyone subscribing to Netflix, people ordering more through Amazon, companies advertising more on Facebook, they've had increased cash flows during this time. So those are the companies who they've been investing money into. They won't invest into companies who they think the share price is not representative of the value of the underlying company. But they still think there's a long way to go on share price valuations. We did ask a question about the US stock market falling from all-time highs in February. The US market fell by over 30% in a matter of weeks. Well, we're only a few percent away from the US market being back to all-time highs. So the next question then was, what will 2021 look like? And as I say, the guy who was speaking who just laughed at that. He said, this year has been so crazy, it would be just impossible to predict what 2021 would look like sitting here right now. And they're looking at it on a week-to-week basis, albeit that they do think the underlying fundamentals of most economies around the world, once we do get trading again, when employment figures can come down, may not look so bad. And that he said was what the US's biggest problem was restarting the economy and reducing unemployment. So we spoke to him on Tuesday, and as I said in the previous slide, by Friday the data had come out about the US unemployment figures, and it had come down, and it had surprised the market. It would have surprised T. Rowe Price how much it's come down. Other concerns they have is Donald Trump and his trade war with China. I don't believe the Chinese are going to back down. They're certainly not going to pay for the cost of this virus, the China virus, as Trump has been calling it. So that's going to lead to more trade tensions as the year goes on. That could destabilise markets. Again, we've touched on Trump wanting to get re-elected. So he is wanting to open the economy as soon as possible. By all accounts, he hasn't spoken to Dr. Fauci for the last 2 weeks because Dr. Fauci wants to be a lot more restrained in reopening the individual states. It should also be remembered that the actual individual states and the state governors are responsible for the healthcare costs in those states, so they are going to be more cautious as well. But they've got to weigh that up with restarting the economy and getting people working again. If we look at the state of Florida, a place I enjoy going on holiday, a lot of their theme parks are trying to get reopened. The governors in Florida and the local mayors all want this to happen as safe as they possibly can. So the theme parks are reopening with a lot of restrictions attached to what people can do when they get there. But the point is, you will have thousands and thousands of people. Obviously, that Disney and Universal are the main employers in that section of Florida. They need to get these people working again so the economy can kickstart. So hopefully, the data that we saw come through in May, 2.5 million new jobs created. June could be just as good, if not better, with obviously all the businesses reopening. And then as we get into July, obviously the 4th of July is American Independence Day. And I was reading that a lot of businesses in the hospitality sector, restaurants, bars and such like, they would like to be open for that weekend, as they say that is a great time to get people out and get people spending. So the markets have bounced back to a very good level, and we aren't that far away from where we were back in February. So hopefully, as these updates continue on a weekly basis, we're not going to be too far away from getting back to those levels. That brings us on to the performance figures of the various funds that we look after. We put the Royal London funds on first this week. Around about 25% of our clients invest into these portfolios with Royal London. The GRIP Portfolio 3, which is the more cautious portfolio we use for those clients who are in drawdown in retirement but have a cautious attitude to investment risk. That's down -4% almost from the market highs of February. The Government Retirement Income Portfolio 3, which has, I think it's around about an extra 15% invested in the stock market compared to the GRIP Portfolio 3. That's down -5 over that period, and that was effectively a quarter of the year. The Royal London Government Portfolio 5, which is a pre-retirement portfolio, which has a much higher stocks and shares content again, that's -5.49. So you can say that it's still the stock market centric funds that have performed the worst, but the lines are starting to catch up now. If you look at the Royal London portfolios over a 12-month period, all three of those in question there are very close to being back on par over a 12-month period. The GRIP Portfolio 3 is positive by 0.18%. So the ones that are minus there, hopefully we're not too far away from them turning positive. Excuse me. The Risk Score 2 and Risk Score 3 portfolios, around about 2/3 of our clients are invested in those portfolios. Probably is an equal split, maybe a few more in Risk Score 3 than 2. We've been running this slide every week from the notional £100,000 invested in the middle of February. At the start of the crisis, we dropped almost 20% towards the 27th of March being a particular worst day I seem to remember. But from then till now, the markets have come back, and these portfolios are back to around about £96,000 now, which we think is fantastic from where it was earlier on in the year. This is the Risk Score 2 and Risk Score 3 portfolio just for the last week. Sorry, the last month, from the beginning of May to the 5th of June. If anyone had said to me on the 5th of May that the £90,000 on the notional value there, or even 89,000, I think it was, on the 5th of May, would be up to 95, 96,000 already, I don't think I'd have believed them, because it has been such a quick uptake over the month. As you can see, there's been one or two downs along the way, and that's what we were expecting: positive weeks, negative weeks. But we're very pleased that we're almost back to that notional 100,000 figure. And anyone who's coming to see me or getting an annual review document sent in the post, anyone whose annual review dates fall around about this time, and now seeing that the 12 months to the 4th, 5th of June was positive on the previous 12 months, which we've got to be happy with, I suppose. Just finish off again looking at the VIX index. The VIX index, we've said, is a measure of risk in all markets around the world. At the end of March, that index of risk had gone through the roof. It was 500% higher than what it was going into February. It's gradually come down along the way. There's been some bumps, as you can see, where things did feel a little bit riskier. You can see there that the early May, there was a spike again. But as May then continued and we got into June, it's come down again. Let's hope that red line continues to go down again. This is a graph we'll continue to share with you and give you updates as the weeks pass. So thanks for listening again. Still getting good numbers of people listening to these updates every week. Hopefully the information we pass across to you is useful and appreciated. If you need to get in touch with us about anything, please don't hesitate to do so. And I'll be in touch with you next week. Bye now.